All right, everyone, and welcome to the Everything About Wealth podcast. I'm Denny Troncoso, and I'm your host. And I wanted to get back with you to discuss the deal that I went over last time. We went through the numbers on that. So if you haven't seen that, definitely check out that episode. I'll put a link somewhere here, either below or above or something like that. But today I'm going to do the second part of this one that I promised you. It took a little while, but I got it together for you. And it's about buying a $30,000 lot and building a rental property and seeing, is it a good deal? So we're going to go through this part of the process here. So is buying a $30,000 rental out, building a house that rents for $2,350 actually a good deal? So I ran the numbers on the same house. We ran the numbers on the selling, and now we're doing the renting today. And we're going to focus on cash flow. We're not going to focus on selling. So we're going to look at cash on cash return, not ROI. So the difference between the two, the ROI is going to calculate your numbers on sale. The cash on cash return, we're only going to just focus on the rental income that the property is going to produce after expenses, after the mortgage, and what is your net coming back to you based on your investment. Cash on cash return, it's money in your pocket every year. ROI includes that profit when you sell. It also could maybe run it with a refinance number there as well. It's up to you. But right now, we're going to focus just on the cash you're going to get. Let's say you're going to hold this for a long time. And what are you going to get every year? Two very different conversations here. Sometimes you're investing for a long term, you're investing because you're going to sell. You put the ROI number, it's good to know. But some people, maybe they're investing for cash flow and they want to know what's going to be their return every year for this investment so they can compare maybe with a bond, maybe with a dividend stock, or maybe with other real estate, right? So, what are you going to get doing this versus doing something else? So it's that opportunity cost, as they talk about, right, in Economics 101. So most beginners confuse these. So just make sure you're aware of that cash on cash ROI. And then when we get into some advanced concepts, we'll be talking about internal rate of return and all that, but we'll keep that for another day. So here the deal snapshot, right? So it's a 4-bed, 2-bath home, 1,850 square feet, 2-car garage. So this is a nice general American house for, a 4-person family, right? So you got 4 bedrooms. Each child has a bedroom. You have an extra guest bedroom, or an office, right? People want to have that 4th bedroom, or just a playroom, anything there. It could be for an in-law as well. 2-car garage, right? Because everybody needs to store their stuff somewhere. If you're buying and you can afford it, it's going to cost, with this builder that we talked to, it's going to cost about $227,000. 227,000. Over here, looking at the lot and the closing, right? So you're at 32,000 for that, right? So the lot cost 30,000. I think we said closing costs were about 2,000. This was in our past numbers. We're going through them again. And then, so our total investment all in, we're at $259,000, right? That's how much we paid to buy this and build this. Buy the lot, build the home. Now we rent that for $2,350 a month, right? So we looked it up. I typically use either Zillow or Rent-A-Meter. The best way to do is to go around and drive the neighborhood and see what else is for rent in the area. And that's going to give you a good idea of what that property will rent for. So this one came up with $2,350. Did a quick analysis there on Rent-A-Meter. Very useful site. All right, so now expenses. So this is where people get a little confused here because there are some expenses when we buy rental property. I know some people, they think they buy it and they're like, man, it rents for 1,000, the mortgage is 1,000, it pays for itself. Well, there are some other expenses that you need to think about. Not that you can't buy that way, but you should know going in what you're getting into. So most people underestimate expenses, and expenses are about 40 to 50% of the rent. So if the house is renting for 1,000, expect that the expenses for the property are going to be 40 to 50%. And we're not talking about the mortgage. We're talking about taxes. We're talking about insurance. We're talking about property management. We're talking about repairs. We're talking about capital expenses. And of course, for repairs and for capital expenses, we're averaging these, right? Because some months may not be any repairs, but other months we'll have a lot of repairs. And then capital expenses are for our roofs, are for our water heaters, are for our plumbing, our electric, our appliances are also capital expenses. And I think I'm missing one more thing. So construction, structural work that would be considered capital. AC. AC is another main big one. All right, so now we estimate these things with this home. Since it's new, the repairs, I am going to use a lower number. I am use about 5%. Typically, you want to use about 10% if it's an existing home. And also, if you don't have a lot of reserves, if you don't have a lot of cash to protect you in case an emergency happens, I recommend that you have allocate more money for those expenses in case there's a surprise. You're not like, man, I should have saved for this. So taxes, let's say it's $250 a month. Insurance, that's about taxes was about, we said 250 a month, 3,000 a year, more or less on a home for this price range, safe number. Always you have to check with the property appraiser if the home is a new home, see how they calculate the value for that property. They're looking at the millage rate. You can go on the website for the property appraiser. You can calculate it yourself. I typically use like about 80, 90% of the value because the property appraiser cushions it a little bit. They don't want people trying to fight them on the value all the time. So they'll cushion it a little bit. You can call them and you can ask them, hey, how do you calculate the taxes for real estate? And that's a good way because they'll tell you, well, you also need to take into account this, or we're going to have a special tax for this. So now you can have an accurate figure, but always learn how they do it and do it yourself. Don't just listen to them. Oh, it's probably going to be this, because sometimes they make mistakes too. They got the wrong address or wrong math, etc. So just double check it. All right, so we did the taxes, insurance. We got an insurance quote. We talked to our insurance agent. Hey, give me multiple quotes, please. I'm looking to build this property, and I want to know how much it's going to cost me to insure it per year. That could change, right? Because it's going to take some time to build it, but at least you have an idea when you get into it. Property management. Talk to management companies in the area. For a house, if it's only one house, it's going to be about 10% to manage it. And then also, it ends up being more than 10% because they're going to keep most of the time first month's rent or half of first month's rent. You can try to find management companies in the area, see if you can negotiate some of those things. But that's, just standard stuff there. And you can manage your property yourself, or you can just hire somebody for leasing. And but a few things. You should be willing to learn about the landlord tenant laws. If you're not willing to learn about that, I wouldn't recommend that you get into property management. If you have a lot of extra time, you think this is going to be a good career for you for the long term, you're expecting to buy more properties, hey, go for it. Start managing your own properties, but make sure you're getting involved, learning the landlord tenant laws, attending landlord meetups or your local association, because it is work, okay, to do it, and it takes skill to do it right. It's not rocket science. Anybody could do it. They put in the time and effort, but just make sure that you have the time and that you're willing to learn what's necessary to do it right. All right, because there's ways to do it so you can have less stress and more success. But of course, it is work. Property management is work. All right, so turnover is real. People move about 34% per year. So if you have 10 houses, about 3 to 4 of those people are probably going to move. There's ways to reduce that, but we'll talk about that in another episode. And then even new homes break. So that's why they have warranties. And sometimes the plumbing, maybe something got loose or something, there's an electrical, a panel, something's going on with the panel, one of the breakers, or, AC, something happened. Even new homes, issues come up, drywall, something happened, there's a leak or humidity's not right. So all those things, you really need to save money for the repairs, okay? For the capital improvements. All right, so we did the math, right? We had all these expenses and we ended up with an NOI, or net operating income. In real estate, net income is considered net operating income. Just another fancy word, but just so you understand the lingo in real estate. And they call it NOI, net operating income, for your net income. And this is before the mortgage, guys, right? So you still have the mortgage that is going to come after that. And this deal produces $1,500 per month in NOI. All right. So that's about times 12, 18,000 per year. Hey, pretty good investment. Pretty good investment. You're making 18,000 per year. Now, of course, we need to calculate the cash on cash to know for sure. And we're also going to evaluate a few options. Did you pay for this cash, or did you borrow, or what did you do? So let's go with option number one. Option number one, you paid all cash, right? So you invested $259,000. A couple ways you do this. If you don't have the 259,000, maybe you had it yourself, right? Which is great. Some people do, but not everyone. But you could partner with someone that has the cash as well. And then now this is a way to do that type of deal. And you guys can, split the profit. Of course, you got to hire an attorney, do, the operating agreement, and other things, possibly maybe a PPM. We'll talk about that in another episode, how to structure maybe some of those partnerships, because I know people are interested in that. But let's say you had the cash, no partnership here. You invested $259,000. The property produces 18,000 per year in cash flow, right? After there's no mortgage here. So the return, cash on cash, 18,000 divided by 259,000 is a 6.95% return. 6.95%. Okay, so it's not a home run, but I like it. It's cash on cash every month, every year you're getting close to a 7% return. And then there's some other benefits there. We're not talking about. We got depreciation, which is helping with taxes. We have principal appreciation, which is the value that, real estate typically goes up over the long term. It's about 3%, 3 to 4%. And then we also have principal. Well, in this one, we don't have any debt. So no principal reduction here. So there's, 7%. It's pretty good. We're comparing these to other investment types, right? Let's say if you invest in a bond or something else, what are you getting there? And then deal for the headache of dealing with real estate. All right. Now let's look at option two. Option two, you said, you know what? I'm not going to pay it all cash, but I'm going to get financing and I'm going to get a loan for about 75%. And, here you're going to have to pound the pavement a little bit. It depends on your financial capacity, depends on the builder, and it depends on, you know, their experience and the lending markets. Some lenders do this. All right. So this one, you're going to invest 64,750. All right. So you finance the difference, which I think it was like around 190 and 195 or ish. And you now you have cash flow of $3,266 per month, right? So it went down quite a bit. You're making about 20% of the cash flow that you were making before, a little less than that. The return is about 5%, right? Because now, even though you're putting less money, right? But you're also having a lot of debt that you have to pay, right? Because now you borrowed close to $200,000. That debt needs to be paid and it eats up a lot of your cash flow, right? So that just lowers your return as well. So more risk, less return. You know, if you don't have the cash, an option you could do to do this deal. Option three, 50-50. Invest half the money in cash, and then you're going to borrow the other half of the money. So you invested 129,500. Your cash flow is 8,177 per year. And what's your return? Your return is about 6.31%, right? 6.3. So it's a bit of a balanced option. I actually like it because you don't use all your cash, right? And it's close to the cash return, right? Of about almost 7. You're at 6.3, but now you don't have as much cash out. So it's a bit balanced. Now, there are risks to this, right? Because now you have a debt payment. Now you don't have as much flexibility. You always have to make sure that payment every month. You should have some reserves to cover that mortgage payment in case something happens. The home is empty for a few months. You should have some backup, some emergency funds for that. How much emergency funds? At a minimum 3 months, preferably 6 to 9 months. Have other backup plans. And let's say you only have 3 months, but maybe you have access to credit, right? In case you need to access credit, in case something happens there, where even if you rent it below market, you can rent it, but you can help cover some of that in case you run into a situation. At the beginning, some people want to get into real estate and some people can take a little bit more risk. Some people don't want to do that. Completely understand. Whatever works for you, whatever you're more comfortable in. But there's ways to do it, but just try to protect yourself because the economy sometimes it dries up and then there's not a lot of renters. All right, so big lesson. The return is close to the interest rate, right? The interest rate is about 6.5% is what I use. Right now, I'm recording this February 2026. Interest rates are about 6.5 for investment real estate and even some conventional loan options, right? For lending. The leverage doesn't help much here, right? So let's say if you were getting a cash on cash return if the debt was lower, right? So the debt typically magnifies the return. In this case, because it's so close to the return that you're getting, the rent is fixed, and then the interest rate is 6.5. It's only like 0.5% of difference that you're getting. So it's not really helping them. It mainly adds risk, right? So getting more debt in this deal, it mainly adds risk. Unless maybe the 50% may be an option, but it's adding a lot of risk. I like that the cash, it gives me a lot of peace of mind. And the debt, like I mentioned before, is going to require some reserves. So who's this deal for? Well, it's good for new investors with cash. If you're a new investor and you don't have a lot of cash, I would, I would dig a little deeper. I wouldn't do new development. It's very, very challenging, especially there's a lot of risks. You're gonna make errors, you're gonna make mistakes. It's less forgiving with mistakes. Rather, if you did a renovation, light renovation, start with paint, flooring, something simple, general repairs. Maybe you're doing a light fix and flip, or you're doing a light rental. You buy an existing home, you renovate it a little bit, then you rent it, less risk versus with new construction. Now you have the builder. If there's delays with that, if something happens, weather delays, other things, and then you don't have any cash flow during that time, right? So I would steer clear from now. If you have the cash, maybe you have a background in construction, you have a bit of an understanding. Now maybe you can take a little bit of the risk, and then also if you have enough cash to sustain your mistakes, right? So if you make some mistakes, you're like, I have a few, I have the money, I have savings, I can get through this. I really want to do this down the line. I want to build. Then you can try that. Not ideal again if you're over leveraged and you have no reserves, right? Because if you don't have reserves and the home gets empty and you're like, man, how am I going to pay 2,300, whatever the mortgage is? I think the mortgage wasn't 23, the mortgage was like 8 to 15. So, you got to kind of be careful with that. Not don't fall into that because it could happen. Builder quality matters more than the math, right? So if you don't know the builder and you don't have credibility, then I wouldn't do it. And the only way you're really going to know the builder is through their past deals. So you need to get references for what they've done. Of course, check them out. What's look them up on the state website. Do they have any complaints? Look at past deals. How many construction projects have they done? Sometimes I even look at it from like a lender perspective, getting a lender even for a loan amount that's low. It's a little bit of a headache sometimes, the loan lender, but they're good, especially getting started, because they can be a good partner for you because they're going to ask a lot of questions. And you may not have thought of things that they're asking, but it can help protect you to get a good deal done especially from contractors and builders, because they do this all the time. And some people, they don't, they're may not as organized, or they're trying to maybe cut corners, etc. So final takeaway, what is this deal? It's not a home run, okay? But it's a solid, stable deal. If you have the cash or you have a good understanding this could be a deal that you can do for cash flow, appreciation, and tax benefits. And then also principal appreciation if you have debt. So principal appreciation, I mean, a principal reduction if you have debt. That means that every month you're making a payment on the mortgage, it's being paid down. At the beginning, it's not going to be a lot, but if this is a long-term hold for you, could work. Sometimes you're not maybe not trying to be a mogul. You're trying to buy a few properties every couple of years. Next thing you know, you own 10 properties over 30 years. You paid them off. That's great. And every market is different. So run your numbers. Sometimes the market, there's a lot of better deals in existing properties that you can buy. You don't have to deal with this. You can buy something quick, get into it, renovate it, rent it out. You're off and running. And then you're learning and you're seeing what works and what doesn't, right? Because now you rent this out and you're like, man, I didn't want to be a landlord. You went through all this process. It doesn't work as a flip. You're not going to really make a lot of money for your effort. I mean, learning is good, right? But if you can learn faster, it's better. Learning faster and is better. So if this helped you, please like and subscribe. We'll keep posting videos on useful information on real estate investing. I also do some stock investing. I also share some of that. Value investing in particular, no day trading over here. That's not my style. And no hype, just math and just the numbers and sharing and growing together. All right, guys. So I'll leave it there. I'll see you guys next time. Everything about wealth. See ya. Take care. Bye.